Welcome to TheoTrade. This is Don Kaufman. It's August 26, 2019, and you are watching the TheoTrade evening video. There's about 25 minutes left inside of the trading session with, the S&P's up some 15 handles. But if you missed it, take a look at the range inside of the overnight session. I know you should have stayed awake all night trading this one. 80 handle range. Again, an 80 handle range inside of overnight trade. I mean, just to be able to display this, I had to go to a 30-day, 1-hour chart. We gapped lower, okay, at the open. By the way, just want to throw this one out to you for those of you that do look at gravity points. I mean, one of the gravity points that we hit just after the markets opened on Sunday, I mean, effectively is 28.11 is the absolute low of the marketplace. We ripped after that, but hey, net, this is not much of a rally after, well, the S&P's tanked by the tune of about 70 points on Friday. You're getting about 15 of it back inside of today's session. And there's a few other standouts over here. The bonds, well, they didn't have much to say during the trading session. For those of you that do look at bonds, these are driving a lot of the order flow throughout the course of the evening. Again, inside of a relative about half a point range. Notes also a little bit more docile, which really kind of took some of the pressure maybe off of the financials. But the financials are still well below that 2650 level. Net, I thought this was a perfect time to discuss maybe a little bit less about markets, a little bit less about individual stocks, and open up to a discussion that, well, everybody needs to be aware of. Kind of what I term the great bond extinction. All right, so I want to talk again just a bit about bonds and more appropriately some of the bond yields. Now, as many of you may or may not necessarily be aware of, okay, many of the bonds, for example, here I'm going to look at the United Kingdom debt to begin with. Many of them have actually gone to what we term negative yield. And you look around the world, and every single day, more and more of the world's debt has gone negatively yielding. But let's start with the UK debt. And again, I'm going to highlight specifically some of the yields. Now, if you're not familiar with this, this is a 2-year, a 5-year, a 10-year, and a 30-year. Well, depending upon the sovereignty, right? Depending upon different country out there, well, the debt might be varied, meaning that not everybody has a 2-year, a 5-year, a 10-year, and a 30-year. But here in the UK, this will work out fine. You can actually take a look at the UK. And again, of course, they are positively yielding, although quite minimal. Their 30-year is sitting right around the 1% level. All right, moving forward from the UK, we actually have a German debt. Now, Germany starts to get quite entertaining. First of all, German debt, well, all of it is negatively yielding. All right, here we actually have the bonds, the 2-year, the 5-year, the 10-year, and the 30-year, all of them which now are effectively negatively yielding. Now, it's almost difficult to kind of wrap your mind around the idea of negative debt. I'll just give you an example here. You go out and for the most part, you buy debt. You buy $100,000 worth of debt, and at the end of 30 years, you actually have less money in doing so. So you're actually buying the debt. You're saying like, hey, you know what? I'll take your 30-year debt, and you lose money over the next 30 years on that debt. It's almost incomprehensible that you're paying to take on risk. It's a lose-lose situation. From the German debt, we actually cruise over to the Japanese debt. Many of you are aware most of the Japanese debt is effectively negatively yielding, other than maybe their 30-year. Again, they also have a 20-year that's, this is relatively flat, 0.06%. All right, and last but not least, of course, we're going to look at take U.S. debt. And so some of the U.S. debt, which is a much larger yield curve in this particular case, you've actually got 3 month, 6 month, 12 month, 2-year, 5-year. They'll sell anything to you in the U.S. out to the 30-year. And you can see our 30-year is still right around 2%. Now, where am I going with this? Why spend the time to look at some of the negatively yielding debt? Because it's just been in the headlines nonstop. But there are some major issues with this. One of the things you want to start to think about is bond yields, okay, or lack thereof. And I want to make that very, very clear that, in here I put like, bond yields. I mean, effectively, we're saying the bond yields are next to nothing. They create just a diversification crisis. And I want to stress that, what does that mean? All right, many of you have looked at some of finance models, and the older you get, the more you might want to go into conservative products, for example, bonds. Well, there's no bonds effectively left. I mean, you go out there, you buy a 30-year, what are you going to get? Next to nothing on it. I mean, sure, you could put some of your capital into some short-term debt in the United States, but even when you start to look at the short-term debt in the U.S., you have to realize that the yield that you're getting right now, in for instance, 3-month, well, if the Fed fund futures come down, okay, that is the Fed lowers rates, this is going to come down with it. So even these yields, which you can get on 6-month and 12-month and 2-year, all right, there's still some yield out there. It may not be long for this world, okay? So then we face, again, kind of this diversification crisis. You can't shift from the S&Ps, for example, out into bonds, especially if the bonds go negatively yielding. So capital then becomes forced to find yield in just unthinkable places. Where are you going to go? I mean, effectively, if debt starts going again to negative yield, where are you going to go? All right, in place, of course, of the debt market, which is effectively massive in comparison to, when you think about the S&P 500, the U.S. debt market is absolutely massive. Now, that debt market includes, of course, not just U.S. Treasuries, but some of the corporate debt, some of the muni debt out there. It is massive. Low yields they were just temporary until they became permanent. And without bond yields, okay, many asset classes are going to have amplified risk. And the last point on this, and then we're going to actually look at a couple of different charts on this, low beta has become high risk, okay? Again, it's kind of what we call the great bond extinction, and just want to start thinking about this. We're going to be talking about it extensively here at TheoTrade, specifically in the TheoTrade chat room over the course of the next few trading sessions. I'm going to close this up, but I just wanted to give you an idea. When I say low beta is high risk, if you're taking a look at something like the utilities lately, now I've been picking on the utilities a lot in many of the recent sessions, but the utilities, I mean, these things are trading like a tech stock right now. If you take a look at the year-to-date percentage, they're up some 19%. The reason I bring this to your attention, if you're unfamiliar with beta is an underlying relative movement versus the S&P 500. For example, if the S&P 500 moves, let's say 1%, the XLU, historically speaking, is supposed to move at about 0.25%. Okay? Is that going on right now? Of course not. Okay? The betas are completely out of whack right now. Anything that's got yield associated with it. Again, this is the utilities, 3.1%, but anything that's got yield associated with it, go take a look at, for example, AT&T. Come on! It's 5.86 yield over there, but its beta is 0.56. When you start looking at this, though, again, it's trading like a wild tech stock. Are they reinventing the wheel? You're like, no. They have phones. I mean, you can go in, you can look at some of the other telecoms too, like Verizon, which has also been relatively volatile, not necessarily up. By the way, these stocks don't necessarily have to trade up on the year, but anything with yield, okay, is going to have heightened risk from this point forward because we just have a diversification crisis. Again, low beta. And a lot of people, they move into low beta products to avoid risk as they get into their later years. They move into things like bonds to avoid risk. Without bonds, what have you got? I mean, literally, what have you got? Now, this is not per se making a bearish case for the broader marketplace. Okay? Quite the contrary. It's just forcing capital into unusual places. And again, unthinkable amounts of risk are being taken. Extraordinary amounts of risk are being taken to squeeze out, okay, infinitely smaller yields. That's the big takeaway from what we're now calling, again, the great bond extinction. Well, yield in bonds, it was nice while it lasted. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.